What's up, investors? Trump wants to make investment great again. Today, we are diving into a major policy proposal that could completely reshape how we analyze public companies. President Trump wants to eliminate quarterly earnings report and move to semi-annual system. If you are invested in biotech or really any public company, this could fundamentally change your investment strategy. Let's break down what this means, the good, the bad, and what it could mean for your portfolio. So here's what's on table. Right now, every public company has to report their financial and business updates 4 times a year, every quarter. Trump's proposal will cut this in half to just twice a year, bringing us closer to European standards. The administration argues this could save companies time and money and let management focus on actually running their business instead of constantly preparing reports for Wall Street. But as investors, we need to ask, is this actually good for us? Let me give you the bull case first. Companies, they spend millions on quarterly reporting. Accounting fees, legal costs, management time, that's the money that could go towards R&D, expansion, or returning cash to shareholders. More importantly, quarterly pressure creates short-termism. How many times have we seen great companies make bad decisions just to hit quarterly numbers? For example, CEOs cutting R&D spending, postponing necessary investments, or rushing into product launches just to satisfy Wall Street's quarterly expectations. For biotech specifically, this could be huge. Drug development takes years, not quarters. A biotech CEO shouldn't have to explain every 3 months why their phase 2 trial hasn't magically accelerated. Semi-annual reporting might encourage more patient capital and longer-term thinking. But here is where it gets tricky for us investors. Quarterly reports are our lifeline to understanding what is really happening inside these companies. Think about biotech investing. In 3 months, a company could announce trial results, or get FDA approval, or face a regulatory setback, or maybe burn through cash faster than expected. Waiting 6 months to find out? That's a massive information blackout. I made money and avoided losses specifically because quarterly reports revealed changes in cash burn rates, shifts in pipeline priorities, or early signs of competitive pressure. Take that away and we are flying blind for months at a time. And it's not just biotech. Tech companies pivot strategies, face new competition, or see user growth trends change quarter to quarter. Consumer companies deal with seasonal variations and supply chain disruptions that do not always follow a neat 6-month schedule. Here's what really concerns me: information asymmetry. Right now, insiders always know more than we do, but quarterly reports level that playing field to a certain extent. Move to semi-annual reporting and that gap widens significantly. Institutional investors with direct management access, industry contacts, and research teams will have a huge advantage over us retail investors who rely on public filings. We could see increased volatility when reports finally come out because 6 months of pent-up information gets released all at once. Imagine trying to value a biotech stock when you haven't heard from the management in half a year. So what does this mean for how we invest? Well, first, due diligence becomes even more critical. We need to dig deeper into annual reports, investor presentations, and conference calls. Following industry news, competitor moves, and regulatory developments becomes essential. Second, this probably favors larger, more established companies over smaller names. Big pharma can weather information blackouts much better than smaller biotech companies burning cash on clinical trials. Third, we may need to adjust position sizing with less frequent updates. The risk of nasty surprises increases, so smaller position sizes make sense until you have high conviction. Now, let's be realistic about implementation. This isn't something Trump can just decree. It would require changes to SEC regulation and likely congressional action. There will be massive pushback from investor groups, pension funds, and institutional investors who rely on quarterly data. Even if it passes, there would probably be a long implementation period and potentially exemptions for certain sectors or company sizes. This proposal represents a fundamental shift in how public markets operate. While it might reduce short-term pressure on companies, it would significantly reduce the information flow that we rely on as investors. For now, it is something to monitor rather than panic about, but start thinking about how you would adjust your investment process if quarterly reports disappear. What do you think? Are you for or against this move? Please drop your thoughts in the comments below, and if this analysis was helpful, smash that like button and subscribe for more market insights. Friends, I'll catch up with you again in the next one. Bye for now.